What's up everybody, Nate here, and Michael Burry just admitted that he was wrong. Last month, Michael Burry went to Twitter to tell his millions of followers that they needed to sell. He didn't elaborate on anything, he just said sell and then immediately deleted the tweet. Since then, Michael Burry has not tweeted at all, but he just posted a follow-up tweet to say that he was wrong about telling people to sell, and the reason has to do with all of you. What did he say? Now, when Michael Burry tweets, it's kind of a big deal in the business and financial world because Michael Burry is known as the Big Short. He actually predicted the 2008 housing market crash and profited off of it, making millions of dollars betting against big hedge funds and investment firms. So basically, Michael Burry was one of the few people that saw something that nobody else did during the time. So when he goes to Twitter and tells people to sell, a lot of people end up listening. People just sort of take his word for it. So why exactly did he tell people to sell back in February, and why is he now backtracking on that statement? Well, one of the reasons that Michael Burry was calling for people to sell during that time was because the Federal Reserve was just getting ready to raise its interest rates once again. Now, the Federal Reserve has been raising interest rates for a long time now, but this particular interest rate hike, Michael Burry believed that it was going to cause a massive market sell-off. He was trying to warn people to get their money out before they lost everything. The Federal Reserve has been raising interest rates for a while, but the more that they raise them, the harder and more restrictive our economy becomes. So as the Federal Reserve raises their interest rates, demand goes down for everything. So it's a lot harder for people to get a mortgage. It's a lot harder for people to get an auto loan because mortgage interest rates and car loan interest rates are so high. People are just barred from getting those loans because they can't afford the monthly payments. Same with credit card spending. So overall, it's just a lot harder for people to spend money. So at the end of the day, they just don't spend as much money, which means there's a lot less money for banks, there's a lot less money for auto companies and other businesses. And on the flip side, investors also don't invest as much either. They don't want to take on as big of a risk because interest rates are so high, and now that debt gets a whole lot harder to pay off. And if it doesn't work out, now they have all of this really expensive debt and not really much to show for it. So investors tend to pull back during this time too, and we have definitely seen that over the last few months. Now, the Federal Reserve is raising its interest rates in order to bring down inflation because as that demand comes down, people aren't really able to spend their money anymore. So that means that prices have to stay pretty stable because nobody is really buying anything and there isn't any demand. Again, though, that hurts a lot of other sectors of our economy, like unemployment could go up because now businesses have to lay people off in order to cut costs. And businesses aren't getting investor money and they're not getting consumer money. So it just creates a whole lot of problems simply by just raising those interest rates. And Michael Burry believed that interest rates were getting way too high and we could see a wave of layoffs, and we could also see businesses start to cut back even more and consumers start to cut back even more. But he didn't account for one thing. If you look at the numbers over the last couple of weeks since Burry made that initial sell tweet, well, the entire financial market and stock market and housing market haven't all completely collapsed just yet. Sure, if you look at the major indexes like the Dow, S&P, and NASDAQ, they definitely have had their off days, but we have not seen a major stock market crash as of yet. And I think the major reason for this is because what would normally happen when the Federal Reserve raises their interest rates is businesses and investors and consumers would all pull back everything and you would see a massive sell-off. But investors of today are a lot different than what we have seen in the past. Financial education is very much different now, and over the last couple of years, Americans have been educating themselves a lot on how the stock market works and who the Federal Reserve is and what their role is in our economy. Now they kind of know how everything works. Many of them are not investing for the short term. They're investing for the long term, and they understand that during the long term, regardless of Federal Reserve interest rate hikes, the market tends to go up. Now, that's not to say that it's always going to go up. We don't know what's going to happen in the future, but historically, when the Federal Reserve has raised its interest rates, when we have seen unemployment or wars or stock market crashes, the stock market and other markets always recover to set new record highs. That is what has always happened in the past. And I think there is now a generation of investors out there that understand how the stock market works. They have taken the time during the pandemic and over the last couple of years to completely educate themselves on the entire stock buying process. They know not to be afraid anymore. So what exactly does this mean for Michael Burry and the stock market? Well, it means that there is a certain resilience amongst all investors right now. 2020 really sparked a lot of things in a lot of people. Before that time, you had a lot of institutional investors, and there wasn't a ton of regular retail investors on Wall Street. Most people were investing in their 401k. They had an asset manager that pretty much handled everything on their behalf. A lot of these individuals, for lack of a better term, have been around for a long time, so they tend to work based on tradition. 2020 saw a huge influx of investors like we have never seen before, so now we have millions of new people entering the stock market completely as beginners. And while that has created a lot of volatility in years like 2021 and 2022, stock market investors, retail or not, are starting to adapt to these new market conditions, and they're not just selling based off emotion. They are selling or buying based on their long-term goals, and that is keeping the stock market pretty much historically stable right now. It's safe to say that investing in the stock market is risky. You are never guaranteed to make money. In fact, you are guaranteed to lose money at some point. That is how the game works. However, technically speaking, you don't lose money in the stock market until you sell your investments, or if a company goes straight to zero and files for bankruptcy. So in short, even if you bought a stock market index or an individual company at $100 and you're down to $50 right now, if you don't sell, then you technically haven't lost any money, because next year the stock could be worth $150 and now you made money. It really just depends. And like I said, based on previous market conditions, well, it was pretty obvious for Michael Burry that everybody was going to start selling, because that's what people have done in the past when the Federal Reserve raises its interest rates. Now, just because Michael Burry is backtracking on his former statements doesn't necessarily mean that he was completely wrong here. There is a lot of instability in finance right now that simply cannot be ignored. We just saw one of the largest banks in United States history essentially collapse overnight. Millions of people have pulled hundreds of billions of dollars out of the bank, and we're starting to see the massive fallout from that. Inflation is still historically high, even though it has started to come down. The Federal Reserve has said that unemployment could rise to around 4.5 to 5% by the end of this year, simply because of their rate hikes. That means a lot of people are about to have a lot less money, and that's going to affect earnings reports. It's going to affect companies getting funding to grow. It's going to affect the housing market and the stock market. And at the end of the day, there is a ton of global unrest right now that could end up affecting our economy here at home, like the protests in France and Germany, and of course the war between Russia and Ukraine is still going on. So it's not so much that Michael Burry is wrong, he's just not right yet. Now, obviously, when you're investing or doing anything with your money, always do your own due diligence. Don't just blindly listen to somebody on the internet like me or even Michael Burry. The most important thing you can do right now is be financially educated with your money and understand how all of this works. Whether we see some catastrophic economic events in the future or our entire economy remains fine, you need to be prepared with your money for both scenarios. That means financial education today is more important than it pretty much ever has been. Do your own due diligence, research and learn as much as you can, so that way no matter the opportunity, you are ready to capitalize on it. We're talking about the stock market, the housing market, and the Federal Reserve almost every single week daily on this channel. So if you want to subscribe, be sure to do that before you go. Financial education is very important, but it's only one half of the entire equation here. So the other half is knowing what is happening on a day-to-day basis in the business and financial world. And if you want a really easy way to do that, our team puts together a free daily newsletter where we're breaking down everything in the local and global economy, and even the stock market, housing market, cryptocurrency market, you name it. We're talking about it over on Market Brief. So if you want to do that for free, go ahead and click the link in this corner right here. Oh, and if video's more your thing, I've got another video for you to check out right there. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.